Hello, everybody. Welcome to Friday and another show of Talk Money with Tom. We do this live broadcast every Friday from 12:15 to 1 p.m. on Pacific time. Really excited that you can join us today. We've been having a great time doing these shows. Our outlook is that we're trying to help people build their wealth at a faster rate. And one of the best ways to do that is to increase investor knowledge. And that's what this show is about. We are going to be covering financial planning, tax planning, and investment management is kind of our three big subjects that we cover. And so this is a question and answer show. We've already gotten quite a few questions this week, actually. So you can send in the questions at any time. But if you want to send the questions during the show, which we would love, you can send them to Ask Tom at talkmoneywithtom.com. And then Katie, who's here on the screen, will be our moderator. She gets those questions. She'll ask them. She might ask some follow-up questions. And then Eason, who's also here on the screen, is another one of our advisors. He will be, asking some follow-up questions. And we really like to kind of build out the questions. That's why we do the follow-up questions, just to be able to, make sure we're covering everything that you need to know in order to kind of have some more information. And of course, you can ask a question directly of Eason if you'd like, which is no problem. So um, altogether, if you really are interested in continuing your education, one of the things you might want to do is subscribe to the channel that you're looking at right now. There's a subscribe button and there's a little bell next to it. If you want to hit that, you'll get notification. We put lots of different videos, free resources about these three areas on our channel, so you'll get notified. If you don't want to do the subscribe route, then you can just get on our email list and just send us your email address at asktom@talkmoneywithtom.com, and we'll put you on that list, and you'll get a link to some of the videos as they come out. And if you like it that way, that would work well too. So, so what I want to do here, I want to start with just kind of talking about a summary of what happened this week inside the stock market. Really interesting week, actually. And so I want to point out some of the highlights and kind of the things, the analysis from what I see, and where things might go from here as far as that goes. So I'll start with just sharing my screen here, and we'll look at this one chart. Okay, so this is the S&P 500 this week. Okay, actually, this is last Friday. Here's Monday, Tuesday, all the way through to now. And what's happening here is each one of these bars is a 10-minute increment. And so you can kind of see what's happening. We had a down day Friday, big down day on Monday. Actually, this is the biggest down day of the year as far as that goes. And then just an amazing recovery. And as of right now, we just hit an all-time high on the S&P 500 going back, for 1957, I think, is when the S&P 500 first came into existence. So, and today we're at the all-time high, highest it's ever been. And so really amazing kind of how this recovery happened. Oftentimes, in order to really move into new highs, into new areas, you need to see some downturn. It just creates momentum. It creates buying, and people come running in, buying the dip, so to speak. And then, essentially that created this momentum to get us where we are. If we look at kind of where the leadership was this week, this is from Morningstar. This is what we call the style boxes, the 9 style boxes. And so they put companies in these different categories, so you're either a growth company or a value company or core. And so growth is, high growth company, value is relatively inexpensive, and core is in between. And we got large and mid and small cap companies as a whole. So you can see what's happening this week is the growth side is definitely winning. And it makes some sense. One of the things that's happening this week is we're getting a resurgence of this Delta variant of the COVID-19 virus. And so, what we normally see in the reopening side is over here in the value arena. And that has obviously started to sell off because there's some thought process that the reopening might be delayed or at least, somewhat compromised. And the growth stocks often are able to operate quite well without having physical facilities. So software companies and Microsoft, Apple, those types of things. And these are the ones that did quite well last year also, is this particular column as far as that goes. So really fascinating arena right now for what's working. And this is definitely the area. And if you look at what's happened in the last 1 year, So this is the S&P 500. Now each one of these boxes is now one day. And this is going back. You can see we had a downturn in September, October. Prior to the election, there was some concerns. But altogether, this is a phenomenal run. And here we are at the all-time high today. Really strong. I mean, really, really good altogether. The 200-day moving average is moving really strongly up. The price is way above that. This is a great stock market right now. And yet, one of the things that I really wanted to try to emphasize this week is that there's, especially since we had a down period, Thursday, Friday, and Monday were all down, and Monday was down quite a bit. The people that are always talking about crashes come out of the woodwork every time the markets fall. So here's a headline from today. So Rich Dad Poor Dad author tells investors prepare for a terrifying market crash. Okay. And then here's one from a couple weeks ago. Harry Dent, stock market crash likely within 3 months. Okay, so this is every day. This is coming out and it's hitting us all. And one of the things, from an investor education standpoint, you really want to know what to focus on and what to kind of ignore. And I'll talk about kind of what to focus on, at least at this point. But these types of things tend to keep people at a much lower equity exposure than they might. So here's some examples. So let's go back to October. Okay, remember October, we'll show you the chart again here in a minute, but it feels like a classic October crash is on the way. Market strategist warns. Again, that's from the end of October last year. Here's another one from the Motley Fool. New data suggests a stock market crash may be imminent. These are out every day. I mean, you can find one of these pretty much every single day that's out there. And again, let's examine the chart. So here's what they're talking about. Those two articles that I just mentioned are right here. Terrible, terrible time to sell and to lighten up the load on your equity exposure and what have you. So really, you just want to be quite cautious about, those types of articles. And here's what I would focus on. Number one, I think one of the biggest threats right now is inflation. It's a potential as far as that goes. There's kind of two big things that I would focus on. So if you're worried about inflation, then what you want to do is watch the 10-year Treasury yield, because the bond market is very sensitive to inflation, especially the Treasury bond market. And so you can see this is the yield on the 10-year Treasury, and it fell right during the April-March timeframe of last year. That's when we were shutting everything down. The Federal Reserve was lowering rates, basically to zero at that point in time. And then we went sideways, and then the interest rates started to recover. As a matter of fact, it really started to move February, March this year. And that is because we had a stimulus package that came out in December, another one that came out in January, and the reopening's happening, and there's this pent-up demand, and there's all this cash on the sidelines, and people were worried that things might get too hot. And so we saw this big run-up. But now, okay, look at what's happening now. It is coming down, right? I mean, what the 10-year Treasury market is telling us right now is that inflation is softening. The threat of inflation is less. That's a good thing. Normally, when the 10-year Treasury is coming down, there's some fear that, the economy might be coming down here in the future. Well, in this case, because the economy is expected to be so hot, having the economy slow down some is good. It kind of puts us in this Goldilocks zone that they talk about. So that's number one. Watch that. That's doing really well right now. That's a good thing. And then, of course, here I've shown this chart. I'll show this chart every time probably, because this is a really important area right here. If you look at what's happening with the Federal Reserve, what's called the federal funds rate, the Fed rate, is essentially what they charge the banks. This goes all the way back to 1955, and you can see these gray areas are recessions. And look at all of these. Every recession was basically accompanied by a higher interest rate increase, right, before those recessions. When you look at the low points in those interest rate periods, there were no recessions. And oftentimes the recessions are associated with some of the big downturns. This is our big 2000 downturn, or big 2008 downturn. We did have a recession actually last year, but it only lasted 2 months. It was the shortest recession ever. The pandemic was an economic impact, that was fairly short-lived because of the stimulus money that came out. But right now, the Fed fund rate is around zero. We haven't had big, significant, terrifying market crashes when the Fed funds rates are at zero. So I would be a little bit cautious about some of these headlines as far as that goes. So that's kind of what I'm looking at right now. It was a really great week, actually, altogether. Obviously, we'd rather have it never come down and just go up every single day, but that's not really how the stock market works. It's not how life works. Life is not a straight line. Either is the stock market. The stock market is a representation of human emotion, and essentially, sometimes you need to see those downturns to get that next upward leg as far as that goes. So, very good week. Look forward to seeing what's going to happen next week. And thank you. All right, let's get started on the question and answer session here. And why don't you fire away, Katie, with the first question?
First up, we have a pretty meaty question asking, I'm 67, I'm retired. A lot of my friends are taking their Social Security at 67 instead of waiting until 70. What do you think I should do?
Yeah, that's really interesting. So this is a question that came in a while ago, and it's something I've run across many times. I actually do a seminar on Social Security maximization. It's an area of specialty. We specialize in retirement, and so one of the big pieces of that is Social Security. And so if you think about that, if you're 67 now, I'm going to assume that means you're at full retirement age, and so it's not a bad time to take Social Security. If you take it 62 to 67, you actually get less as far as that goes. You basically get, a penalty for taking it early, and that penalty lasts for the rest of your life. But once you get to full retirement age, one of the big advantages to waiting is that they will increase your benefit by 8% a year, plus any cost of living increase that happens for that year. So, for example, if you were waiting in 2021, this year, you'd make the 8%, plus you'd make the 1.3% cost of living increase that they had for this year. You make a 9.3% guaranteed return in growth on your income. And what it does is it increases the base of your income for the rest of your life. And so if you can grow it from where it is now to 9.3% higher, every cost of living increase you get after that is going to be based on this higher base. And so if you can just wait that 1 year. But here's what's happening this year. Because we're having a higher inflationary period, there's some rumors that we might even see a 5 or 6% cost of living increase in 2021 that would actually pay out in 2022. They'll announce this in October. Think about that for a minute, because if that actually happens, if you wait through 2022 for your benefits, you might actually get a 13-14% increase on your money on Social Security. And again, the S&P 500, which we just looked at, which is a phenomenal index, averages 11% a year over the long term. And in that long term, there's all kinds of downturns and all kinds of hassles. You could make 14% maybe next year, guaranteed from the US government with no downturn, and it increases your base. Um, so, not everybody should wait. And you really need to run a Social Security maximization plan to figure out what your break even age is, what other assets you're going to withdraw from, and how much impact that's going to have on your overall net worth. Uh, but in a generic sense, without knowing all of those things, to answer this question, it might be a good idea to kind of wait. Now, most people don't wait. 50, I believe, 8% of people take Social Security at age 62 here in America, and only 8% actually wait until age 70. Um, I've got some clients that wait till age 70. They've been very happy with that. So, if you're married, try to get the bigger one to grow as much as you possibly can, because if one of you passes away, the bigger one stays and the smaller one goes away. So maybe if you want to take one early, you take the smaller one early, potentially, and leave the bigger one to grow until age 70. And that way there's something there for whoever, is the survivor of that couple. So lots of different pieces to take a look at in Social Security planning.
So, how does life expectancy play into that? Maybe mm, like let's say I'm just not exactly the greatest health. I don't see myself living past 80. Is it then kind of warrants me taking a little bit earlier?
Yeah. So let's say, for example, somebody who's 67, could take it now versus waiting till age 70. They're giving up, say, 3 years worth of income and they're going to get a higher income, but how long does it take to get that back? And let's just say, for example, in your scenario, it's 82. So by 82, you've now made back, you're kind of at a break even point. And then after that, right, you're just making more and more money. And so, a couple of things I would think about there. Number one is, are you a couple or not? If you're single, that's different. If you're a couple, there's a chance that one of you makes it past 82, higher chance because there's two lives there. And how is the health of your spouse? So that's something to consider. Um, but if you think your health is really, really poor, and you've got some solid thoughts about that, then yeah, you can take it earlier. There's nothing wrong with that at all. But the biggest challenge in financial planning, I'd say by far, is people living longer. Because it just makes your money have to last longer and longer. I had a client who called up and was taking the last dollar out of their IRA at 93, and his comment still rings in my ear constantly. It's just, "Hey Tom, I just didn't think I'd live this long." And so, and now he's pretty much out of money, right? So you don't want to get into that spot. So that's the kind of the piece there. You'd have to be pretty certain that your health isn't going to work out, and only a few people are really in that position, in my opinion. It's hard to tell, but it's a good thing to think about. It is a piece of the equation, and these Social Security maximization programs that we do, we can put in shorter than average life expectancy. We can put in an age, and it'll tell us, hey, so if you say, I think I'm only going to live till age 80, we can put that in there and see what it comes back with as far as, what's the optimum age to take it. And it might be earlier because, they're talking about a much shorter time period. But again, keep in mind that if you're married, it's not just you, it's both of you. And so that's a piece of it.
What percentage of my final work earnings will I need in a retirement income?
What percentage of my final work earnings? Oh, yeah. So let's say you're making $100,000 and you're going to retire. How much are you going to need in retirement? There's all kinds of rules of thumb. It's 80% and all kinds of things. Uh, it's kind of interesting because in real life and experiencing and I've watched thousands of people retire. I'd say it's pretty darn close to your current income, unless you're really, really trying to cut back or something along those lines. Because what happens is you save money all over the place. So if you're no longer putting money into your 401k, for example, you're no longer having to buy as much in the way of clothes. You're not driving to work, so gas, and mileage on car drops down. Those types of things. But you also kind of increase some of your expenses. You're traveling a lot more, especially early in retirement. Most people travel more, and so there's some compensating pieces there. I'd say it's probably in that 80 to 100% range on average. It depends. We've seen some people do it where they really cut back because they're really really interested in retiring, and they don't have enough money, and they're smartly cutting back to say 50%, and they're happy with that because they're so much happier to be retired, even if it means with less money. But on average, I'd say it's really closer to 100% of current income because that's the lifestyle that you're trying to replace, as far as that goes.
Would you say it's instead of income, more current expenses would be a better way of like thinking about it since you're trying to maintain how you're living right now and your income though like tells you how you can live, but it's your expenses that are really the bottom line.
Oh, definitely. The weird part is, in my experience, is people have a really, really hard time actually nailing down their expenses. And so I guess one of the ways that I've seen that's most successful, because it's very easy to see your incomes, because there probably aren't that many. You might have lots of dozens and dozens of expenses. Some of them are quarterly and annually and monthly, but your incomes you kind of know, and so you take those incomes, and then if you can just figure out how much your overall savings grew, and just subtract that, the rest is your expenses. That money disappeared. So if I have $100,000 worth of money coming in after tax, right? and I look and I built up my savings between my, what I added to my 401k or savings account, say 20,000. Well, I just spent 80,000 last year, right? I mean, so that's a fast way of kind of figuring that out. But yeah, no, that makes sense. And trying to, if you really, really get into it, you can, and this seems like what everybody should do, right? Hammer down all their expenses. I hardly ever see that work, actually, almost ever. I do have some clients that are really, really into their spreadsheets and using Mint and different things to really track expenses, and they know everything. But boy, that's like 1 out of 40. Most people don't know exactly what their expenses are at any point in time, but they know their incomes, they know whether they're saving, right? So those are areas that are a little bit easier to track. But yeah, it works out. But again, if you look at it, a lot of people are, spending roughly 80% or more of their inflow. And so that's kind of what you need to get in retirement to replace that lifestyle.
We have a question in for Eason asking, I am in my early 50s and I feel that I am falling behind with my savings for retirement. What are some corrective steps that I can take?
So I would say if you don't have a financial plan, start with a financial plan. You probably want to take an assessment of your situation. You want to know, what do I have? Do I have old 401ks that I've forgotten about? Do I need a rollover, any kind of other kind of, and try and consolidate all your assets so you know what you have. And then what are your goals? How much money do I need to save to kind of hit these goals? And from there, you kind of can start to make a plan. Do I need to save a little bit more money? Like, am I maximizing my match? Or can I spend a little less money here, maybe not take this extra trip every year, and then put that towards my retirement? So there's a lot of things you can do, but I would start to focus on taking that assessment, figuring out where you are, and try and start making steps from there and adjustments.
Yeah, I'll say another thing too. Keep your chin up to a certain degree. A lot of people get kind of really, really worried. I'm way behind. I met was the 30-year-old couple that they had a pretty good amount of savings already, and they felt like they were way behind on retirement savings, which is a good attitude to a large degree, because they'll probably end up with a lot of money. But on average, if you look at what happens, most people save, a vast majority of their money for retirement really in the last 10 years, 55 to 65. There's some reasons for that. The motivation's high. Yeah, that's important, right? So, hey, I'm gonna retire, and that's exciting, and I'm gonna need this money. So both fear and the satisfaction that you're looking forward to drives you. But then also, oftentimes, you're heading into peak earnings period of your life. And maybe some of your other costs are falling off. The mortgage isn't as expensive as it used to be, or maybe you're able to kind of get it paid off at some point, or if you have kids, they're getting out of college, or those type of things. So, yeah, if you're in your early 50s, you're still in a really great spot, as long as you stay dedicated. If you get to 65 and you don't have any savings, that's where it gets really difficult as far as that goes. But if you really go for it for 10 years, and that's where this kind of show, subscribe to the channel, learn, really push all of your knowledge base as far forward as you can. How much can I put into different plans? Should I use a Roth versus a regular, IRA or 401k? How should I invest that? How do I get the best rate of return that I can for the risks I'm willing to take? You really, in my opinion, that's what we're here for. That's what this show is all about. And the Talk Money with Tom YouTube channel has literally hundreds of videos on there. If you start watching those, you'll accelerate your possibilities of kind of building that wealth and getting ready for retirement.
Yeah, and there's a great Chinese proverb: the best time to plant a tree was 20 years ago. The second best time is now. And so, just starting now, you can always, get somewhere. You might not be as well off as you did 20 years ago, but it's still better than putting it off.
Yeah, yeah, yeah. Because it is a mental game. You don't want to get all depressed. Oh, I'm so far behind, and then kind of throw in the towel. That happens sometimes. But yeah, you just want to know where you are. You're doing okay. If you're in your early 50s and you haven't done much, you still got a great chance of doing well. It's going to take some effort. It's going to take some concentration. It's going to take some savings, but you can do it.
We've got another question in from Woody asking, Tom, you discussed planning for one's life expectancy. We are both in our mid 80s and are living comfortably on our Social Security, the mandatory withdrawals from our IRAs, plus income from a modest trust fund with RCS. That's us. With good management, these should not change dramatically. We also have long term care insurance, complete burial plans with Neptune, and great medical insurance. What, if anything, should we be doing differently to handle the remainder of our lives?
Yeah, that's a good question. That was sent in earlier this week, and there's a couple places that I would probably suggest, taking a look. I mean, what you just described is actually a really good scenario, and what I'm going to talk about is just kind of how to maybe, make it a little bit better even. So, number one, want to make sure you have a financial plan in place. So that the Monte Carlo simulation that we use can be run, every 6 months. And when we push the button and we see, what happens, what's the probability of success for the rest of your life, whatever that might be. Um, It'll just make sure if there's any hiccups or if there's big downturns in the stock market or those types of things, you'll have some pre-warning on, being able to maybe cut back a little if you have to. So I would say, Monte Carlo simulation, live financial plan would be one thing to take a look at. And so even in your mid 80s, you might consider some of the ramifications of a Roth IRA, both for your own tax-free growth, but also if you have beneficiaries, it's a nice inheritance for them. They can let that grow for up to 10 years. Uh, and then that leads me to my third point, which is just, a pretty solid, transition plan from you to your beneficiaries. So an estate plan that's in place, looking at the taxes that might happen and what's going to be the best way to get that efficiently through to your beneficiaries if you have kids or those types of things. So those are the pieces I take. Monte Carlo simulation, the Roth IRA conversion possibility might not be there, but it's worth looking at. And then lastly is just some kind of an estate plan to just, how does this get transferred to the next generation when that comes. But really solid situation right now, and it's just, the reason that you're watching this show and the reason you're asking these questions is because you're concerned with your finances, and that's why your situation is so good, and continues to be good. So continue that process, continue the learning, and continue to picking up new ideas and new concepts and keeping up with what's changing. Is something that I think is really important also.
Yeah, and you're just putting like the icing on the cake essentially.
Yeah.
And so with estate planning, you should make sure it's up to date because a lot of times life changes, maybe you have an extra grandchild that wasn't originally in the original estate plan that needs to be added and things like that happen because you can have like famous people like Kobe Bryant had a child after his estate plan was kind of made and
Yeah.
when they're going through a lot of hassle to update that,
Yeah.
going through probate and all that kind of stuff.
Yeah, that is something that gets kind of delayed. Really, they recommend that you look at your trust, or your will, every 3 years or so. And obviously, not many people do that. But that's a good point, Ethan.
Before I retire, is there a way for me to project my retirement income?
Huh. Yeah, you can. There's a couple different ways. Although So just to answer the question, and I'll give you my kind of other thought, a different way to think about it. So first of all, projecting retirement income, you're going to have some kind of projection from Social Security based on when you decide to take it, and you can kind of look at that. So that's an income. Do you have pensions coming in? Do you have rental income coming in? I call these outside income sources. Do you have royalties on textbooks that you wrote, or any of these types of things that I've seen over the years? And so that's kind of the first spot. That'll tell you kind of what's coming in from those outside sources. Then you want to take a look at your overall asset base. And generally speaking, and this is a rule of thumb that I wouldn't rely on too greatly, but look at your asset base and say, okay, I got 3 or 4% I could take out of this asset base and probably keep it intact for the long term. And so if I have $1 million, I could get 30 to 40,000 out of that asset base. Add that to these other outside incomes, and that gives you some idea for what your income source might be like. Um, but the better way to do it is to plug all of that information into a financial plan and then do a Monte Carlo simulation. So the Monte Carlo simulation is basically going to tell you whether it's going to work or not long term because, projecting your retirement income is one thing, knowing what you need for the rest of your life and then running that plan 1,000 times under 1,000 different scenarios, that's a totally different ballgame. So that's what we do. That's what I would do in terms of figuring out, your projecting your retirement income. I would really be looking at trying to project whether or not the situation I'm trying to accomplish in my life with my lifestyle, my retirement age, and all the other things that are coming, does it work? Yes or no? And that's what we answer basically with this Monte Carlo simulation inside these financial plans.
Yeah, and you've told me multiple times, you don't want to take extra income if you don't need to, and
Yeah.
when you're retired, you don't want to use up an asset that you don't need to.
Yeah, that's right. There's a thing we call Rockefeller's rule, which is just sort of part of the tax planning aspect of retirement, which is ideally if you have a certain amount of expenditure. If I need $100,000 a year or something to live off of, I don't want more than that on my tax return in any one year. I don't want 200,000 on my tax return. I want to actually defer somehow that other income if possible. And so that's actually a really, really great refinement of tax planning that can save a lot of tax dollars if you apply that properly. Yeah, it's really interesting.
If I work while receiving Social Security, would that impact my Social Security check?
Yeah, this has come up quite a few times. Somebody retires and then they, find a part-time job or they go back into consulting and maybe they've already taken Social Security. And so, they're wondering what to do as far as that goes and what type of impact. So first and foremost, anytime you have income, and you pay into the Social Security system, your Social Security is going to go up. Okay, long term, it'll go up because you're adding to it. You're basically increasing the basis for your calculation for Social Security, and but if you're making more than $18,960 a year, um, and you're currently receiving Social Security, they'll take back $1 for every $2 that you make over and above that amount. Now, it's not a loss. It actually still gets kind of pushed into your overall Social Security pool. You'll get a higher payout once you do stop working. And so, I wouldn't really try to earn under that just to try to save money. You're not actually saving money. I'd rather make 40,000, have them take back part of my Social Security, and then get a bigger amount when I get done. No matter what, making more money is better. And I've run into so many people that are trying to keep it under that dollar amount just to have that. It's not a penalty. It's just a kind of deferral. Um, so, ideally you don't take it until you do stop working fully, but it's happened quite a few times just because people kind of end up working after they take Social Security that they weren't really expecting. So again, that's not a bad thing. That's a good thing.
We have a really good question in here asking, what impact will inflation have on asset prices, especially if the wages don't keep up with inflation?
What impact will inflation have on asset prices if wages aren't able to keep up? I look at that as kind of two different pieces. The impact of inflation on asset prices in general, and then if that happens to be a situation where wages aren't able to keep up. So, a couple of things there. Number one, inflation's a good thing at certain levels. Deflation, all right, which is the when prices are dropping, is a really bad thing. If you watch what the Federal Reserve does, they go crazy trying to keep it deflation away, and that's why they'll do all of these stimulus things to try to make sure. Because we had a pretty good threat of deflation across the board. There's always deflation in certain areas, because things happen. Like for example. Airline flights dropped like 96% during the pandemic. And so there was some cheaper airfares for a while. Now that's picked back up. But overall, deflation is a problem. So, number one is inflation is a positive, especially if it's sort of under control. So, this 2-3% inflation that the Federal Reserve is trying to achieve. That's incredible. That's exactly what you want. And so when you say inflation as a threat, I'll assume you're talking about like a higher rate of inflation. Like right now, year over year inflation is hitting kind of that 5-6% range, which is, quite high. Back in the 70s, we actually hit 12% inflation. Um, and so when you say asset prices, again, I'll assume that means essentially, the stock market, which is predominantly what we're dealing with. So a higher inflationary period is rough on the stock market. It has a harder time growing. And a lot of that has to do with the fact that it's harder to kind of maintain earnings as a company. When your inputs are constantly going up and you're having trouble to pass that on to the consumer, and then all of a sudden the price is higher, the consumer doesn't have as much to spend, and then you end up with this kind of cascade. But that's where the wage piece fits in. And so that's sort of a second thing. So if you do have a higher inflationary situation, and for whatever reason, the companies as a whole aren't able to keep the wages growing, at that same rate, then there's less consumer spending available for those same number of units because the units are now more expensive. Two-thirds of the price movement of the S&P 500 is consumer spending. And so it really is just a part of the overall high inflationary scenario. And it's why I brought it up. Those are the two scenarios that I can see where the market could have some trouble. Number one, economy gets really hot and inflation comes up really quickly. And number two is the Federal Reserve just raising rates. And those kind of go together, actually. But nonetheless, right now, inflation is actually softening. If you look at that 10-year Treasury, that the bond market is really, really, really concerned about inflation. So that's the one to watch. Much more sensitive. And so we are seeing kind of a softening of the inflation situation. So, that wasn't exactly the question, but that's something to consider, that inflation isn't an issue right this minute. I do think it's going to come here at some point in time, at least, on a temporary basis maybe, but because there is a lot of pent up demand, that's waiting to go here. Um, but we're not seeing high inflation because we got this Delta variant right now. We're also not seeing high inflation because the rest of the world is slowly coming around to the vaccine and the delivery. I mean, it's a huge project to try to get the entire world, vaccinated. And then we got a group of people that doesn't want to take the vaccine too, which honestly keeps a little bit of a lid on the economy because there'll still be this threat of some shutdowns or different things that might happen with these variants. So um, yeah, it has an impact on asset prices at a high level. At a lower level, it's a good thing.
Would investing in dividend ETFs be a good hedge against inflation?
Hmm. Investing in dividend ETFs means that you're investing in the stock market, and the stock market is an awesome inflation hedge historically. What I just talked about, like during these hyperinflationary periods where the stock market can kind of struggle, is a piece of that overall puzzle. But if you look long term, as inflation picks up, you need some assets that can grow at a higher rate than inflation. And the stock market is one of them. And the real estate is another one that is often used as an inflation hedge. So when you're buying a dividend, producing ETF, you're buying stocks, and that's to me that's more important than the dividend is the stock because okay maybe you're getting a 3, 4, 5% dividend, but that stock might average an 11% return like the S&P 500 has long term. So that's a bigger impact, the actual growth of those pieces. And so that's where I'd be a little bit cautious about a dividend ETF purely because they're actually lower growth. One of the reasons that these companies, well, AT&T is a great example. So AT&T has been struggling with its growth, but it pays a really big dividend. Although they just announced they were cutting it back after they spun off Time Warner. But you're not really buying AT&T at this point for its high growth. You might be buying Microsoft or Apple for growth. So I actually think that growth type stocks are a better hedge against inflation than dividend paying stocks, but I don't have a significant problem with dividend paying. I just don't think it's the best avenue for fighting inflation as far as that goes. And generally speaking, when we do get these higher inflationary spikes, If we do have that again, then actually you want to have kind of more rounded portfolio, altogether, and be in kind of that value side. So the dividend itself is useful. It just might not be enough to really help you if inflation does get really hot.
What kind of impact do you suspect the child tax credit to have on the economy?
Hmm. Yeah, I think that actually the child tax credit, which is just starting to roll out now, it's like any other government spending. It kind of depends on whether the people that get it use it in economic sense. So if you take the stimulus and you put it in the bank, ultimately that might create some economic growth because the banks use it, they invest it, maybe you spend it at some point in the future. But if you give the money to people that need it and that are really going to be spending it right away, you'll see a very quick economic hit from that type of expenditure. The disadvantage to the overall scenario, of course, is that you're borrowing, right? The country is borrowing money to push it out to help people with children in this case, and ultimately, there might be some economic stimulus from that. Right now, we're able to borrow. There's been no real problem with our treasury auctions. They're snapping it up. Even though the yields are coming down, it's still selling like mad. And we're actually borrowing at really low rates. So right now, with that child tax credit, I would assume it's going to be a stimulative environment. And people are going to be, a large group of those people are going to be using the money and putting it back into the economy fairly quickly, which should help the stock market.
So do you think that'll have kind of like a ripple effect in a sense that money goes back into the economy, it's spent, so businesses grow bigger, and then they hire more people and kind of change through, and eventually it comes back as taxes? Is kind of the end
Yeah,
goal.
no, that's exactly right. That's the whole premise. Doesn't always work that way, but that's exactly right. So you put the money out, the economy grows, there's more hiring, there's more taxation, employment taxes and all that. That comes back to the government in the terms of, because the bigger the economy gets, theoretically, the higher the tax, payments might get. Also, lots of variables in there, but that's a good way of looking at it overall together. It's really an interesting piece. It's the whole process. We've been doing stimulus type money since the 2008 downturn really heavily, and really, really heavily here in this pandemic, with trillions and trillions of dollars being pushed out. And the market has done great in that environment, and we'll have to wait and see what happens when some of that starts to wear off, because that's one of the things that's going to happen. But right at the moment, that seems to still be, there's other programs in the pipeline with the infrastructure and the families plan and those things. So that's all stimulative, that's all good for the market. The one fear at one point was it was going to all come out too fast and it was going to be too much, and then we would get this kind of inflationary cycle like we were just talking about for the last question. So uh, okay, well, looks like our time is just about up here. I want to thank everybody so much for coming today and watching us, and submitting questions. Actually, some really good questions today, really well thought out. Thank you very much. And I hope everybody has a great weekend. And again, we're here, Fridays, live, 12:15 to 1 every single Friday at the moment, anyway. And feel free to subscribe to the channel. Hit the subscribe button, or let us know you want to get on our email list, and we'll do that. We specialize in retirement, and it's one of the greatest goals. Whether you're 20 or in your mid 80s, it's still something to work on, and it's really satisfying to get that right. So look forward to continue to talk to you about that, and we'll meet with you next Friday. Thank you very much.